All right, picture this. A major global crisis erupts. Your phone is blowing up with alerts. The news is just a wall of screaming red headlines. What is the very first thing you do? For so many of us, that first instinct isn't to call family, it's to open our brokerage app. It's like financial anxiety just hijacks our brain and points it right at our portfolio. But what if that very first instinct is the single most expensive mistake you could possibly make?
No, really, think about it for a second. The news breaks, markets are going haywire. What is your immediate gut reaction trade? Because that one decision, right there, in that moment, separates two completely different types of investors, and honestly, two completely different financial futures.
So let's meet Mark and Sarah. They've got the same starting portfolio, they get the exact same news alerts on their phones. Mark glues himself to the news for 3 hours, hears the word crisis about 100 times, and just sells everything. He acts on pure fear. Sarah, on the other hand, checks one key piece of historical data, turns off the TV, and just goes to work. She acts on data. What happens to their money over the next few years? Well, that's the whole story we're going to unpack here.
Now, to really get why Mark did what he did, you have to understand that there's this massive, and I mean massive, profitable system that was actively rooting for him to make that exact call. It's not some crazy conspiracy. It's just a really, really effective business model.
And this line just says it all, doesn't it? It's so brutally honest. For the financial media, anytime geopolitical tension spikes, what happens? Viewership skyrockets, engagement goes through the roof, and ad revenue just explodes. The more scared you are, the longer you watch, and, you guessed it, the more money they make.
And this chart just lays out the incentive structure perfectly. A headline that screams global markets in freefall after, say, a 2% drop, that gets clicks. It sells ad space. A calmer, more accurate headline like moderate pullback consistent with historical patterns, nobody clicks on that. It's boring. So the media isn't just reporting on your fear, it's actively manufacturing a sense of urgency around it. But here's the data they'll never put in a giant flashing headline. Markets don't actually die in wars. Yeah, they dip, for sure, but then they climb. The Dow gained 50% during World War II. The S&P 500 had positive one-year returns after 73% of all armed conflicts since 1945. I mean, at this point, you have to realize the market is basically a cockroach in a very, very durable suit, and the suit is doing just fine.
Okay, so if the data is so clear, why do so many people like Mark, hit the sell button? Well, this gets us to a really sneaky psychological trap. It's the reason the wrong decision feels so incredibly right when you're in the middle of it.
And this is the absolute key. When Mark hit sell, he didn't feel scared. He felt this huge wave of relief wash over him. He felt smart, proactive. Like he was finally taking control instead of just sitting there watching a number go down. He was doing something. And that feeling of taking action is just incredibly seductive.
But that feeling, it comes at a staggering price. JP Morgan actually tracked this. If you put $10,000 into the S&P 500 from 2005 to 2024 and just left it alone, it grew to $71,000.
Now watch what happens if you try to be smart like Mark and time the market. If you missed just the 10 best trading days in that entire 19-year period, your final balance gets cut by more than half, down to just $32,000.
And here's the kicker, the reason why that happens. The market's biggest green days almost always happen right after its biggest red days. 7 of the 10 best days happen within 2 weeks of the 10 worst. The crash and the snapback recovery, they're practically the same event. They're tied together. So by the time the news calms down and you get that feeling of clarity that it's safe to get back in, the rocket has already left the launch pad. You missed it.
Okay, so if panic selling is the absolute wrong move, what's the right one? Let's switch gears and look at Sarah's playbook. She didn't have a crystal ball. She didn't predict the future. She just had a plan that was built for reality, not for scary headlines.
Her framework is this 6-part strategy, and you really have to understand that the order here matters a lot. Each step builds the financial and, just as importantly, the psychological foundation for the next one, which allows you to act rationally when everybody else is running around acting emotionally.
And it all starts right here with what's called the cash floor. We're talking 6 to 12 months of living expenses set aside. And a small piece of this is in physical cash. Not because you're a doomsday prepper, but because the first shot fired in modern conflicts is often a cyber attack on payment systems. This isn't your investment, this is the buffer. It's the shock absorber that lets you invest without being terrified. So once that floor is built, then you can start making some tactical moves. Sarah added gold, but listen, not because of some front-page fear. She added it because of structural demand from central banks all over the world, who are buying it up by the ton to diversify away from the dollar. She also allocated a slice to defense because, economically speaking, wars are gigantic stimulus programs for that specific sector.
She also moved into energy. And get this, in 2022, the same year the S&P 500 lost 18%, the energy sector ETF XLE was up a staggering 64%. That 82-point difference in performance is the story of the crisis. While all the headlines were focused on tech stocks crashing, Sarah was positioned in the one thing that was just quietly printing cash.
Now this next one is one of the most counterintuitive things in wartime finance. Everyone thinks you should run to government bonds for safety, right? Wrong. During World War II, standard U.S. Treasury bonds lost 67% of their real value because inflation just ate them alive. The real safe haven is something called TIPS, Treasury Inflation Protected Securities, because their value automatically adjusts to keep up with rising prices. It's a game changer.
And here it is, the single most important rule in this entire playbook. Through all of these tactical moves, there is one thing you do not sell: your core holdings, your broad market index funds. History actually shows that large-cap stocks return more during wartime than in peacetime, with lower volatility. Why? Because the government becomes the world's biggest customer, and all that spending flows directly into the earnings of these big companies.
So, we've seen the two paths, one driven by pure reaction, the other by a plan that was built ahead of time. Let's fast forward a few years and see the real dollars and cents cost of that single decision made on a single chaotic morning. The difference is, well, it's just stark. Mark sold his $40,000 portfolio, sat in cash, completely missed the recovery, had to pay taxes, and ended up with about $48,000. Sarah, she left her core investment alone, kept her automatic contributions going, and added those small tactical positions we talked about. Her same $40,000 grew to roughly $91,000. That's a $43,000 difference, created in a single moment of panic versus a single moment of planning.
So here's the bottom line. The next crisis isn't a matter of if, it's a matter of when. The headlines are going to flash, the experts on TV will sound the alarm, and you will be faced with that exact same choice. So, who will you be? Will you be Mark, funding the fear industrial complex with your own portfolio? Or will you be Sarah, with a plan already in place, ready to just make a cup of coffee and let the system work for you? The time to decide is right now.